Welcome to the podcast Selling Real Estate with Kelly Cook, where we will discuss the latest and most relevant business strategies to help you do one thing extremely well: sell more homes. We'll discuss everything from business planning to lead generation and conversion to past client customer service and everything in between. Join us for authentic conversations and nuts and bolts takeaways you can implement into your business today. And now, Selling Real Estate with Kelly Cook.
Hello, everybody. Welcome back to another episode of Selling Real Estate with Kelly Cook. Got Kelly in the studio here with us in his studio. And Kelly, how you doing? It's we're about midway through the year now. Just give us a little update on how this year's been going for you so far.
Yeah, you know what? It's guys, as you know, I'm transparent. We are behind where we want to be right now, and we're down from where we were last year. And the market, I don't know about your respective city, but in Phoenix, the market isn't any worse. It's very much so roughly the same as last year. In fact, you could make arguments that potentially a little better because we had a spike, or I should say an inverse spike of interest rates at the beginning of the year, which did help, definitely. But then obviously with the global conflict and all that fun stuff and rates going back up, people have kind of like gotten back on the sidelines. But there are still people buying houses. And so it can be an excuse that no one's buying houses when the reality is the data will show you, at least in Phoenix, Arizona, a lot of people are still buying houses. Mm-hmm. So we got some catching up to do.
Yeah. And I think that that's a pretty, an assessment that I've heard all over the country. So obviously we know Phoenix is usually a pretty good indicator of where the rest of things are going in the rest of the country. And so if Phoenix is feeling it, everybody else, I think we're kind of all feeling that same stallment of the market right now, but things are still happening, and it's just about how you are going to get your share, right? I think that's kind of the name of the game here. And if, like Kelly, you are behind where you wanted to be for this year, you're always kind of looking to do better than you did the year prior. And sometimes it's not always happening exactly the way that you want and making the income that you want to right now. But we're going to talk a little bit about kind of another alternative to making money right now and selling houses and all of that. And that's looking at it more long-term and building wealth over time. So I know Kelly was at a couple of masterminds this week, and kind of had this just as a good reminder with something that they talked about, how to build wealth over time, not necessarily just what's my business doing this week, but looking at it more long-term. So Kelly, let's get into it.
Yeah, this is a interesting topic that I feel like we talk about a decent amount, but I don't feel like we also talk about it enough. And so the being in the room or surrounded by people talking about certain topics, which wasn't all about just saving money or building wealth. There was a lot of topics that were discussed, but this one is always near to my heart because the whole Ben Franklin comment and famous quote, a penny saved is a penny earned, does have a lot of truth to it. And the more you get around people who are talking about real stories and doing math, just math, you start to realize that that's so true. And it isn't necessarily how much you make. It literally is what you keep. And so we're going to talk about some things today, I think, that are really important in this podcast that I think there's a framework. I'm going to give you 4 things to think about when you are deciding if that's something you want to work on in terms of building wealth. And then when it comes to evaluating deals and where you put your money and things of that nature, give you 4 more reasons or a framework of 4 things to run it through, okay, as well on this podcast. So right now, if we go to the 4 reasons, the building wealth, guys, takes time. And so the first thing I'm talking about is time. The second thing I'm talking about is compounding. Okay. The 4th thing is going to be the habits that you build. And the 5th thing is going to be your psychology around it and your thought process around it. Okay. So let's talk about the first thing, time. Guys, wealth is nothing but time times money equals wealth. That's all it is. And there are countless stories that are out there. You could just Google them, AI them, whatever you want to do. But there are a ton of stories about people who there's a book written about it, The Millionaire Next Door. The Millionaire Next Door. Read that if you haven't done that, about people who have a lot more money than you think they do, only because they live below their means and they don't visit their money. When I was with Keller Williams for years, I remember the one thing, Gary said a lot of things. Gary Keller, who's a very bright mind, obviously, so said a lot of things that were smart, I think. One thing he said that always stuck with me was, the rich don't visit their money. And I was like, what does that mean? What do you mean they visit their money? And by that, he meant they don't constantly buy and sell. They park it somewhere in a vehicle that was, obviously vetted, and they let it sit for a long time. And that over time will equal wealth. And then you talk about compounding, which is the second thing. As we know, I think the compound interest is the ninth wonder of the world, right? They say it. And I think there's a quote out there I'll probably butcher, but it goes like this: the people who understand it earn it. People who don't pay it. And so you need to understand compound interest and the effect it has. So give me an example. I have a real simple compound interest calculator that you can simply Google as well. If you started with an initial deposit of $5,000, okay, maybe you got it from your grandpa when you were young, your grandma when you're young, that sort of thing, right? But you started in an account with $5,000 and you let it sit there and you put it in a simple index fund. Let's talk about a fund that is representative of large U.S. companies, or a small cap, or even mid cap U.S. companies. Let's talk about the S&P 500 index fund, maybe the Russell 3000 index fund. These index funds that represent these big, if you're a Vanguard, the VTSAX fund. These. And by the way, let me just say one thing real quick. This is not financial advice. Okay, I am not telling you what to pick, what not to pick. Okay, but if you picked a fund, okay. And
some examples.
Just examples, right? And you let it sit there, $5,000 invested at one of those funds, because the average rate of return S&P over the last 30 years is 10.1%. So roughly, any of these funds will return about 10% or more, honestly, if you let it sit there yearly over a long period of time. So if the S&P, if you go the last 10 years, it's even better. It's crazy, right? But if you put $1,000 in per month, so let's say somehow, some way, you could live below your means, and you could somehow choose not to spend $1,000 a month of what you earn, and you not just let it sit in your bank account. Let's say you already had your 4 to 6 month rainy day emergency fund, right? Because I do think that's where it starts. Not to get in a sidebar, because we're not going to go Dave Ramsey on you guys here, but the reality is that's where it starts. You need to have your personal expenses. You need to have at least 4 to 6 months of those saved up in some sort of liquidity and liquid state. Okay. Now, after that, everything $1,000 per month in one of those index funds that returns 10% a year. But in 30 years, if you did nothing more but just contribute to that monthly, you'd have $2.359 million in 30 years. 30 guys, that's $12,000 a year. You're just putting away $1,000 a month. Now, obviously, if you start with a larger bucket, because some of you guys may already have saved money over the course of time, and you want to start with maybe $100,000 because maybe you have less time. But you just started with a $100,000 initial deposit, and you still put $1,000 away every month in one of these funds that return 10%. In 30 years, guys, you're talking $4.2 million. In 30 years. And this is where the time aspect is crucial. Now, no one told me this when I was 22, unfortunately. But again, we talk about when the best time to plant a tree, right? 20 years ago, second best time today. So start today. And you can literally use these calculators to determine if I just did nothing more, but because you don't have to trade stocks, you have to just put it in a fund. Because you guys, at the end of the day, the game is kind of rigged. These funds have to go up. They kind of have to. Over time. So will they go up every year? No, not necessarily. Will they go up every quarter? Absolutely.
There'll be little dips and
things
like that. But the
dips don't go in a straight horizontal line. They go into a 45-degree-ish line over time. And so people outthink this all the time. And if you look at like how financial markets are set up, financial news and markets aren't designed to help you make money. They're there to help you get all riled up about either buying because something's good or selling because something is bad. And by
they want you to take action.
Take action. And by transacting, guess what happens? They make money because there are fees associated with transactions. But if you let it sit there over time and compound, you win. You win. Okay. That's number 3. That's number 2. Number 3 is going to be the um, the the habits that you have, and I think this is where, how do you come up with this $1,000 a month? If you make $4,000 a month and you pay taxes, I mean, the current tax bracket at 48 grand a year is going to be 12%. You're under, for a single filer, right? You're under the $50,400 dollar threshold. So if you're at 4,000 a month and you pay, and you might have state taxes, we're not gonna get all in that, but you pay, let's just call it 15%, because maybe you pay some state taxes too and that sort of thing, right? But if you do that, then you're going to have $3,400 net to take home. So that means, and this is a situation, you'd have to live on $2,400. Well, how in the world am I going to do that? Well, obviously, if you're living in Los Angeles, you're probably, for that same position of making 4K, you're probably making 8K doing the same job, because cost of living adjustments, et cetera, right? If you're living somewhere in a cheaper area, small town America, or something like that, then you're probably getting paid that for the same type of job, right? It's all somewhat relative to an extent. And we're talking, hopefully worst case scenario, but if you're doing that and can you live off $2,400? Well, if you're in a small town America, chances are you could probably rent a 1-bedroom apartment or buy something, right? If someone could give you a loan, a family member, right, to get in the game, you could actually literally live off $2,400. You could do it, right? It'd be tough. Don't get me wrong. It'd be tough. But there's ways to do things like house hacking and sacrificing and doing these things, right? The other option is to obviously figure out a way to get some bonuses or get some sort of pay structure where you can actually, if things go well, based on your efforts, you can actually make a little more, right? That's another thing too. But obviously, if you make, the more money you make, the easier that is. But here's the catch: your habits, which is number 3, is where the behavior of the average American, or probably say human being across America, or the world, I should say, is that when you make more, you spend more.
Mm-hmm.
Yep, that's a good old American way, right? And that's why our economy is based
You
on.
get a nicer car, you get a nicer house, you
I
take
deserve
more
this.
vacations. Yep.
Oh yeah, I've been working hard, which you probably have, but there's a pattern to this, right? And at one point in your life, you will be able to. Now, this doesn't mean you don't use to live on literally ramen noodles and peanut butter your entire life, right? Or at least for 10 years or 20 years. No, but the reality is there should be some sort of sacrifice. So I'll give you a quick little example, and this isn't the best example. I've given an example before about a buddy of mine who actually bought a house in an area that's not so nice, and he house hacked, meaning he bought the house, he had enough money to scrape together, but it's an area that wasn't nice, he did not want to live in, but he not only bought the house in that area he didn't want to live in that really wasn't that safe. So I'm not advising you to do this, but this is an example. He, not only that, he went a step further and he rented the rooms out. And he had people, strangers from roommates.com or Craigslist or whatever it was back then, right? And he rented the rooms out. And he told some stories about some weirdos that he had living in the house, but he was determined to get into the game. Now, that house eventually sold after several years, him living there and making money and living rent free because the rent was covering the mortgage. And then he take the equity and rolled it up into an area he wanted to live in. Wasn't the house his dream house, but it was a better neighborhood, but a little bit bigger house. And then he just repeated the process. And now he's in a phenomenal area of town in the house he wants, with his somewhat dream house with his family and his kids. And then take myself, for example. That first house I bought was not the dream house by any stretch of imagination. I was fortunate enough to get into an area I wanted to be in at the time. Then the market collapsed in 2009, 10, 11. And a lot of people would have panicked and just sold and just cashed out because, oh my gosh, but I didn't. And still own that house today, by the way, and it's worth a lot more. But in addition to that, when we moved to another house, we lived below our means. We bought a house that's easily something we could afford. And honestly, I'm doing a remodel on my house right now. That's going to be very expensive. But I bought that first house in 2008. Then the second house I bought was 2013. That was still in the ballpark because it was a small house in a great area, right? One of those rules of not having the biggest house in the block, the most, but being in a nice neighborhood. And now we're going to be more on par with the neighborhood, I guess, if you will, when this remodel is done. But that was 08 to 2026. For 18 years, I would tell you I live well below my means when it came to housing expense. And so now we're going to take this risk and do this, which I'm a little nervous about because that's how I am. But the reality is for 18 years, there was a little bit of a sacrifice. But a lot of people would have, when it got that bigger house in the nice neighborhood that they could have barely scraped together on, and then been happy about themselves, which, okay, but then you're not able to invest. Okay. Because if your habits tell you that you can live below your means, then that difference, that delta between what you spend and what you make is able to be invested. And that's how you get that $1,000 a month going into an S&P index or a Dow Jones index or a Russell 3000, 2000 index. Okay. Hopefully this is making sense, guys. And here's the thing. Here's the stat I learned too, a little tit for tat. In one given year, there are 10 days in the S&P, for example, in one day a year, or really the market in any of these indexes, right? That are representative of the diversity of all these companies, right? In one year, there are 10 days that if you are invested in the market during those 10 days, you basically make all of your money, your return for that year. 10 days. So if you miss some of those 10 days because you sold, then you buy back in, then you sold, buy back in, you literally missed out on the 10 or the like 22% return that was many portfolios last year. You missed out it because you were too busy trying to time the market.
Mm-hmm.
So the aspect is to stay invested. And then I'll go one more. One last one is the psychology of staying in the market, of fear of loss. Okay, a lot of people, if you make $10,000 in the market, you're like, oh man, that's pretty cool, $10,000. Okay, great, whatever, right? I don't have it in my hot little hands, so I don't really 10,000. Okay, but if you lose 10K, you freak out. This is that 10. It's still 10K,
Mm-hmm.
but think about that. People freak out. They want to sell. They want to liquidate. They panic. They want to, whatever, get the money in their hands so they can have control over it, whatever it is. But that's where you have to just you have to be disassociated with that and say, okay, this is the money I'm investing, and I one day will use this for my retirement or whatever it is, right? For my living expenses, but not today. And market's going down, and there's a bomb going off in some part of the world, and oil goes to $10 billion a barrel. Leave it in,
Mm-hmm.
right? Leave it in, and don't panic.
Everything's cyclical.
I'll say one more thing. Guys, did you know that there are margin loans that you can take? Okay, so you're like, all right, well, hold on, Kelly. Now, if I do this $1,000, that's gonna be really sacrificing to put that in that account every month, okay, or whatever the number is, right? It could be 500, it could be whatever you can do, right? But you should stretch a little bit and try to get as much in there as you can without still compromising your way of life. But that $1,000 is gonna be a lot. So, man, what if I need it? I had that emergency fund for 4 months, but like, what if something really big happens, medical or whatever, right? Then I have to sell. No, you don't necessarily. Okay, there are something called margin loans, and there are plenty of platforms out there that will allow you, if you are invested in a index fund, for an example, or maybe even other things potentially. I'm not an expert on this, right? But I do know this is definitely possible because I've done it. Okay, where you can take the money that you have invested, leave it invested, so it just stays there and just grows like the turtle over time, right? But you can borrow against it at a interest rate. And depending on some of these platforms, these platforms, this interest rate can run anywhere from, call it today, 4.5% up as high as 12%. Okay, but you have $100,000 invested. You need some of that money. Cool. A lot of these will allow you to take up to $50,000, half of that, or if not a little bit more, up to 70% in some platforms. Okay, you can pull 50,000 out, whatever, and use it for that expense. There'll be a borrowing cost to it. But if you are going to need it for an expense, then you have to do what you have to do. But what if you have an investment opportunity that's pretty lucrative that you come across, and that's going to pay you a return of 12%, and you can borrow that money at 6%? Then what? You make the arbitrage. You make the difference of that 6% while your money is still invested in your index fund, earning that compound interest.
I mean, that's what like billionaires do all the time. They always borrow against their investments, essentially, to make more investments.
That's it. So I hope that gave you guys a little bit of a framework here and some ideas to get the juices flowing. And if you do nothing more, then take some time this week or maybe this weekend, instead of using that downtime to watch, the World Cup soccer, which by the way is awesome. But I'm not a big soccer fan, but like World Cup is pretty cool. Instead of just watching it or maybe doing both, then sit down, take some time yourself and figure this out and start putting a plan together so that when you are done working, or hopefully want to be done working, you have some income being able to be generated off your investments.
Absolutely. Well, again, this is, I think, a really good reminder where market isn't going like, the best for a lot of people. It's not raining money for a lot of people right now,
Yeah.
but it is time to start thinking about, okay, well, what does my wealth look like? Not today, not tomorrow, but 10, 20, 30 years down the line. So, I hope this was a great reminder for you all. If you have any questions about this, Kelly cannot give you financial advice, but he can maybe share some of his experiences and what he's done. Kelly, where can somebody reach out to you if they'd like to have more of a conversation about this?
Well said. And hit me up on Instagram at Kelly Cook Homes. Shoot me a follow. Hit me up there. Love to respond.
All right, everybody, we will see you all next time. Bye, Kelly.
See you, Elizabeth.